Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Sean O'Hara, President of Pacer ETF Distributors. We're talking about REIT ETFs today. Sean, welcome and thanks for joining us.
Thank you for having me.
So real estate is the best performing sector this year now, with a return of almost 30%, which is significantly better than S&P 500's return of about 17%. And in fact, real estate recently overtook tech sector, and tech has also done very well, which is up about 29%. So a little bit of background here. Real estate is a relatively new sector. In 2016, S&P Dow Jones and MSCI separated REITs and other real estate companies from the financial sector and elevated them to a new sector under the GICS classification. And now equity REITs make up about 98% of this real estate sector. Mortgage REITs still remain within the financial sector. So before we get into the details of REITs performance, could you please explain what REITs are? Because some investors do not understand their structures and tax advantages and other details.
Sure. So when we speak of REITs here, I think for the purposes of our conversation, I think we're going to be talking about publicly traded REITs as opposed to non-publicly traded REITs.
Yes.
So publicly traded REITs are basically equity investments that are traded much like stocks on a stock exchange, with the distinction that the predominant business for those participants is real estate operations. And so I like to think of publicly traded real estate companies as REITs in that sense, as really nothing more than manufacturers, and they happen to manufacture real estate as their primary product. And the advantage of doing this in a publicly traded sense is that if you're an investor, you can get started with a relatively small amount of money. You don't need a big investment. Number two, there's not a lot of upfront cost. There's basically zero upfront cost, if you will, that goes into it. And then number three is you have liquidity on a daily basis because they are publicly traded. And so you sort of take some of the obstacles that maybe an investor might struggle with regard to real estate, and you remove those by being able to invest in publicly traded REITs.
So REITs obviously have low exposure to trade tensions, and income-focused investors find them very attractive because they pay out very juicy dividends. And I think they have stable cash flows too. So they hold up relatively better than the broader market during periods of high volatility. Do you think those are the reasons behind their excellent performance this year?
I think it's probably some of the driver. I think the fact that interest rates are as low as they are is also one of the driving factors behind the performance of REITs in general this year, in that I think folks are looking for alternatives to traditional fixed income and not finding a lot of attractive solutions out there with interest rates at the levels that they're at. For those investors who are desiring an income from their investment in the form of a yield or a dividend payment, publicly traded real estate is attractive or more attractive on a yield basis than traditional fixed income. And I think that's part of it. And I think part of it is that, folks are starting to think about their portfolios, and we've had a nice long equity bull market here, and perhaps there's a way to reposition some money into real estate, which in the recent years may not have gone up as much as the overall equity markets.
Mm-hmm. So what kind of diversification benefits they provide to the portfolio now. I read that earlier they had low correlations with stocks and bonds, but over the past few years, those correlations, particularly with stocks, have increased. So what have you observed? Do investors get any diversification benefits by adding REITs and REIT ETFs to their portfolios?
Well, I guess if you talk about REITs as an individual investment, you may not get as much broad diversification because you are choosing to buy one publicly traded real estate operator. And so the diversification you would receive would come from the portfolio of real estate that they operated. When you start to think about owning them as a part of an ETF, where you have a number of publicly traded real estate names in one ETF, then you get additional benefits of diversification because you have multiple publicly traded real estate operators in one investment product. So that's, sort of part A to the story. Part B to the story is what you talked about as far as lower correlation or not exact correlation with the overall equity markets. Although those correlation numbers have gone up a little bit, generally speaking, one of the advantages of owning publicly traded real estate in an equity portfolio is that it is not a one-for-one correlation with the equity markets.
Okay. So there are many broad REIT ETFs available to investors, but Pacer ETFs, you offer some very interesting specialized REIT ETFs. So tell us why investors should consider these specialized REIT ETFs versus investing in a broad REIT ETF.
So it's a great question. I mean, our premise is pretty simple, and we think of our real estate strategy with SRVR and INDS as a thematic growth story wrapped inside a real estate play. So when you think about SRVR, for example, it focuses on what we call data and infrastructure, which is the big data center players and the cell phone tower companies and the fiber optic networks, which are all entities who, in one way, shape, or form, there are different entities within the ETF that focus on those different segments of the market. Why we think this is a thematic growth story and why we think it's such an important thematic growth story is that as this technological revolution plays itself out here in the United States and abroad for that matter, and when I mean technological revolution, I'm talking about things like e-commerce, like the Internet of Things, devices connected to the Internet other than computers and cell phones, like your doorbell at home, for example, that you can have a camera on so you can see people coming up to your front door. Your refrigerator will be connected at some point. Your thermostats, all those devices will eventually be connected to the Internet. So that's the Internet of Things. Streaming is going to be a big growth area. Netflix is going to get more than their fair share of competition from the likes of Apple and Amazon and Google and Microsoft and Disney and some of the big content providers. Artificial intelligence is a big area of growth. And then, autonomous vehicles. So those five things that I just mentioned are big technology revolution plays. None of those big five things can take place without a massive buildup in the country's ability to crunch data and store data and process data. And that processing and storing and crunching of data all relies upon computers. And so we need to have a massive build-out in our computing power here in the United States in order to serve these big growing industries. So that's part A of the data and infrastructure story. Part B of it is that the transmission of that data is as important as the ability to store it and to process it. And that transmission will take place primarily via cell phone tower networks with the advent of 5G and the fiber optic networks that we've talked about. So if you're a big believer in 5G, if you're a big believer that, e-commerce is going to continue to grow, if you're a big believer that the Internet of Things is going to continue to grow, if you're a big believer that streaming is going to be a big deal, if you're a big believer that artificial intelligence is going to continue to grow, then these types of investments in publicly traded real estate that serve the needs of those segments of the market have to grow accordingly. And so that's why we sort of think of our real estate story as the thematic growth play. On the flip side of that, INDS very focused on distribution centers, and those distribution centers are essentially the backbone of the e-commerce growth story. So, it's not good enough anymore to be able to order something online and have it be delivered to you in 2 days. We want to be able to order it today in the morning and have it show up in the afternoon. And as more and more, as e-commerce continues to grow, it's roughly about 15% of all retail sales today. There are projections it'll be 20% in the next year or so. That can't happen. That kind of service, I like to call that the infinite impatience of the retail consumer today. That growth can't happen unless we have a massive build-out in the number of distribution centers to serve that market. And then there are specialty players also within that distribution center market. For example, cold storage is one of the biggest growing areas of the distribution center networks as we want to be able to buy more and more of our groceries online. And so if you take a step back and you say, okay, we're talking about publicly traded real estate, but what's the investment premise behind why we did what we did at Pacer? The reason we did it the way we did was we didn't want to own the whole real estate market in one package. What we wanted to be able to do was to deliver the ability to be very targeted in the exposure that you got and be able to play as closely as possible these thematic growth stories that are sort of technology stories, but not necessarily technology stories in the same way as that the FANGs are, for example. Mm-hmm. And a great example of how important this is going to be as we get longer and longer into this bull market is in May of this year, the NASDAQ 100 was down for the month, and both of these ETFs were up for the month. And so even though, for example, SRVR is sort of a technology play, it had a much different return and was less susceptible to that downturn that we saw in May in technology because it serves a different part of the technology world. We like to say it's sort of like defanging your technology portfolios.
Yeah, very interesting. I like SRVR a lot. And in fact, I own an ETF investor portfolio that I manage for our clients. And let's talk a little bit more about this ETF. It's called the Pacer Benchmark Data and Infrastructure Real Estate ETF. Again, the ticker is SRVR, and it basically provides exposure to companies that generate revenue from real estate operations in the data and infrastructure sectors. Of course, very important very rapidly growing fields. And as you mentioned, many of these are builders of 5G data infrastructure. So could you tell us a little bit more about how this ETF will benefit from 5G buildup? And also let's talk a little bit about the top holdings. I see that American Tower, Equinix, and Crown Castle. These are the top three holdings. The ETF is a bit top heavy. These top three holdings, in fact, account for more than 46% of the portfolio. So tell us how this ETF and these companies, these REITs will benefit from 5G.
So 5G is a really important thing, right? 5G is what will be at the center of us being able to allow the devices that we use on a day-to-day basis, most importantly our cell phones, for example, in a way that will increase the utility of that device. In other words, if we want to be able to stream videos on our cell phone in a better way, that can't happen without a big buildup in 5G. And 5G is nothing more than the fifth generation, if you will, of cell phone communication ability. That's going to be driven by the two names that you mentioned, American Tower and Crown Castle. There needs to be two big growth spurts that go along with this that are right in those two companies' wheelhouses. One is the number of cell phone towers in the U.S. has to increase substantially because in order to get to that 5G, we need more dense coverage. We need to be able to process more information faster, and the only way that can happen is if we expand the network and have more cell phone towers out there. And then the second way that will get done is by increasing the number of nodes per tower. So right now there's roughly 15 nodes on the average tower. Some estimates are that's going to go up to about 85 nodes on each one of these towers. And that just means more revenue per tower for names like Crown Castle and American Tower, who are the two big cell tower companies. Another name that's in the portfolio that may not be as obvious to folks as a 5G play is Lamar Advertising, for example, which is a big billboard company. The regulation about building more towers is in some places pretty onerous, and there aren't any more towers that are allowed to be built. And so what Lamar figured out is that they could use their freestanding billboards as essentially dual-purpose structures. They'll continue to be sort of an old-school billboard company, but they're starting now to install the cell phone nodes and working with folks like Crown Castle and American Tower to connect so that we can get coverage in places where it might not be possible to put additional cell phone towers. And so this growth is sort of going to be astronomical as we start to move towards the coverage of 5G. With server as an investment, I think it's worth noting that we think it's much bigger than just 5G, even though we believe that 5G by itself is a pretty big investment theme. And the reason we think it's bigger than 5G is that all those other things are sort of related to it. E-commerce will only be able to continue to grow as more and more people feel more and more comfortable being able to order things via their cell phone or their connected device. Streaming will continue to grow as a result of that. The Internet of Things is sort of dependent on this infrastructure as well. And so it's a bigger theme than just 5G, even though 5G is a big theme unto itself.
Very interesting. Now, let's take a look at your other ETF. It's called the Pacer Benchmark Industrial Real Estate ETF. The ticker is INDS. And this, you mentioned, is poised to benefit from growth in e-commerce. And we have seen that American consumers, they have been shopping more and more online. So tell us a little bit more how this ETF benefits from e-commerce.
Yeah. So can I do one thing before we get to that? And I just want to talk about one more name in server because it's important. Because
Sure.
as we talk about the cloud and the growth of the cloud, over 90% of computing instances now take place via the cloud.
Yes.
And there are big names that are in the cloud business. Amazon has a cloud services business. Microsoft has one as well. And they're contributing pretty handily to both those companies' bottom line. So you can get some cloud exposure by owning those names. The name that's at the top of our list, for example, in SRVR, Equinix, is a essential player in the cloud network business. Okay. What typically will happen is that Amazon will put their main cloud facility in a rural area because the space is available, number one, and number two, the costs are lower there. But they then need to be able to connect that cloud facility to other cloud facilities, and most of that connectivity gets routed through an Equinix data center that are more centrally located. I like to think of Equinix, if you will, as the router for the cloud business, where instead of having a cloud facility with just one service provider in it, they actually have multiple service providers in their facilities. They call this co-location. They want them to be these computers to be as close as possible and connected to these other cloud facilities that are sort of single-use cloud facilities. So Equinix is a big part of that. INDS, I mean, for anybody that's driven down the highway in the last couple of years, you start to see these massive buildings being built out all along the highways with, hundreds of garage doors on the outside and usually a whole bunch of tractor trailers sitting outside of them. that those facilities are the facilities that enable the delivery via e-commerce of all the packages, the goods and services that we're buying online now to be made within the time frame that's now sort of become the standard, which is no longer, I'll get it to you in a week or two or a couple of days. It literally has to be either overnight or later that day.
Yes.
And so these distribution center operators, like, for example, Prologis, which is one of our largest holdings, is focused exclusively on that business. And they have, if you will, streamlined and created a competitive package for themselves in becoming one of the leaders in the development and building and operation of these distribution centers. It's really sort of a unique skill set that they possess. And so we think, INDS is another one of these areas in the publicly traded real estate market where you're going to see tremendous growth because this marketplace has to evolve in order for us to get to where we want to get to.
Yes, Amazon offers one-day shipping now, and many other retailers, they're also trying to compete with Amazon by offering same-day shipping or two-day shipping at the most.
Or they have to, or if you can't compete, you're going to go away.
Right.
And so, when we initially launched this, our premise was it was probably okay, but a little bit off the mark. We launched these two sectors out of the sectors that we had licensed from Benchmark. There's six others. There's 8 in total, but we focused on these to begin with because we sort of thought this would be the e-commerce real estate story. From when you push send on your device, whether it's your cell phone or your computer or your tablet, until they press your doorbell, you can track those transactions through publicly traded real estate. Yeah. What that did was that sort of pigeonholed us, if you will, into the real estate part of people's portfolios. And although we think we fit there, we actually are getting more business from folks today as a core part of their equity portfolio in what they're labeling a thematic growth sleeve. And so we've pulled back a little bit from that initial positioning of press send to press your doorbell to say, well, here's the 5 big technological developments that are taking place today in the U.S., and all of them are served one way or the other by either one of these 2 ETFs.
So I'm looking at the top holdings in the CTF, Prologis, which you mentioned earlier, Duke Realty, and Liberty Property Trust. These are the top holdings, and this one is also a bit top heavy. These 3 account for about 43% of the portfolio. Could you tell a little bit more about these top holdings?
Well, Prologis, as we mentioned, is the leader in the manufacture of these distribution centers. Liberty Property Trust is an interesting story. We actually just recently bought Liberty Property Trust's home office building here in Malvern, Pennsylvania. Wow. They decided to completely exit their commercial real estate business and focus exclusively on distribution centers because they think it's such a big and growing area. And so you have them in the portfolio as a name. And then Duke Realty, again, same thing, more kind of regionally located down in the lower southeastern United States, but again, a big focus on distribution centers.
And you offer one more REIT ETF. It's called Pacer Benchmark Retail Real Estate ETF, ticker RTL. So in general, we have seen growth in e-commerce and decline in brick and mortar retail. So tell us why investors should look at this ETF.
It's sort of a contrarian play, Nina. E-commerce is 15% on its way to 20% of all retail sales. That still means that 80% of all retail sales are going to get done through traditional brick and mortar stores. However, I think the landscape is going to shift a fair amount. And so owning the big publicly traded real estate names that focus on that retail space allows you to sort of get a portfolio of the highest quality retail players that have capital and understand how to operate. The largest holding, for example, in that, I think, is Simon Properties. And here outside of Philadelphia, where we live, Simon Properties operates King of Prussia Mall, which is one of the biggest malls in America. Not the biggest, but one of the biggest.
Yes.
And they have done a tremendous job of positioning that mall And so it doesn't matter when you go there. It doesn't even matter if it's Christmas or some other holiday. If I went today, it would be very difficult for me to get a parking space at that mall. And so you'd think, well, that seems kind of contra to what's going on with the whole e-commerce phenomenon. But they have done a nice job of packaging, for example, high-end luxury retailers in one section of the mall. They've got, some big box guys that have a pretty good following, whether it's Nordstrom's or like Neiman Marcus. Nordstrom's is an interesting story on the retailing side in that they have sort of a multi-channel approach to it today. You can buy in the store, you can buy online, or you can buy at their discount Nordstrom's rack operations. And they've packaged all three of those things together in one sort of customer loyalty program where you get points no matter where you go. So for those operators that have figured out how to survive in this retail apocalypse that people talk about, there's real value. And so it's sort of an out-of-favor, contrarian story, and that's why we launched that one, because we didn't believe that all bricks-and-mortar retail was going away. We felt like the strongest and best operators would survive, and that's typically what you'll see inside of that ETF.
Okay. And talking about the top holdings for this ETF, Realty Income, Simon Property Group, which you mentioned just now, and Regency Center. These are the top three holdings for this ETF. Anything else you would like to add about top holdings?
No, I think it's, again, the difference between, what you would see if you drove down 1A in Florida and you saw sort of all these empty sort of storefronts along that highway, and what the big mall operators, for example, are doing. It's light and day difference. And so they can actually develop the foot traffic that's necessary. And the smaller, non-publicly traded mom-and-pop operations, we think, are going to continue to struggle.
Okay, that makes sense. Anything else investors need to know about investing in REITs, particularly in the current market environment?
Yeah, the other thing I would say is that the focus on interest rates and yields and the yield curve that have all been sort of a boogeyman for equity investors are actually a great advantage for publicly traded real estate, primarily because the pricing for the debt that they take on to build out their inventory is usually based off the 10-year. So even though a 10-year yield at like 150 might be seen as a potentially negative sign for the equity markets, or an inversion of the yield curve perhaps be seen as that as well, that's actually a slight wind at the back here in the short run for these operators, because their cost of funds is priced off that 10-year.
Okay, very interesting. That's all we have time for today. Sean, thanks again for joining us.
Thank you so much for having us.
Thanks for listening. If you want to learn more about these ETFs, please visit paceretfs.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.